Well, the natural gas market attempted an early Tuesday rally, driven more by short covering than by genuine cold weather demand. Prices briefly broke above the $4 resistance and tested the 50-day moving average, but the move quickly failed, with futures slipping back to $4 within hours. This price action signals growing trader uncertainty, largely fueled by inconsistent weather forecasts that still fail to show a meaningful cold push 2 weeks out. The current elevated price levels are being supported mainly by speculative expectations of stronger demand tied to rising LNG exports. On a daily basis, LNG feed gas flows climbed to a 3-week high near 18.8 billion cubic feet per day on Monday, driven largely by increased volumes to Cheniere Energy's Sabine Pass facility in Louisiana. Flows there rose to roughly 5.1 billion cubic feet per day, up from a 7-day average of about 4.9 billion cubic feet per day. Meteorologists are calling for a modest cooling trend across much of the U.S. through January 8, but overall temperatures are still expected to run warmer than normal across most regions. Looking further out, the 8 to 15-day forecast appears too warm to sustain a breakout rally, in my opinion. This is the window that professional hedgers tend to focus on. Against that backdrop, it's not surprising that March and April futures are trading at a noticeable discount, while only lingering expectations for a colder February are keeping front-month prices hovering near the $4 level. If a meaningful cold wave fails to materialize over the next 2 to 3 weeks, the odds increase for a corrective move lower, with prices potentially gravitating toward the $3.25 area as winter approaches its peak and weather risk continues to fade. Meanwhile, U.S. natural gas production remains robust. Average output climbed to a record 110.1 billion cubic feet per day in December, surpassing November's previous monthly high of 109.6 billion cubic feet per day. Unless colder weather materially disrupts supply, this level of production should act as a stabilizing force for prices, limiting sustained upside moves. Moreover, despite the recent larger-than-normal withdrawals that briefly pushed storage slightly below seasonal norms, upcoming EIA reports are expected to flip the picture right back again. Storage surpluses are projected to rebuild through January, traditionally peak demand season, at least on paper, though this year seems determined to rewrite that script. Against this backdrop, today's elevated price levels already look generous, to put it mildly, and it's hardly shocking that hedge funds have started cutting long exposure, as I pointed out in my previous analysis. That dynamic was clearly visible on the daily chart this morning. The rally pushed into the 50-day moving average near $4.17, stalled around and then quickly rolled over, sending prices lower into the session just minutes later. The momentum generated by that failed breakout has brought the $3.70 retracement zone back into focus. From a technical standpoint, the message is fairly straightforward: resistance remains firm, and traders continue to favor a sell the rally approach. It also suggests that professional money is paying close attention to the warmer 8 to 15-day forecast, which keeps the broader tone bearish. For now, the market appears willing to downplay the storage deficit at least until colder weather gives traders a reason to take it seriously. If you enjoyed the analysis, drop a comment, hit like and consider supporting the channel. It really helps keep things moving, and see you next time.